Hey everyone, welcome back to Corporate Decoder. Today, NXG Cushing Midstream Energy Fund just filed a prospectus supplement, and I am seeing a whole lot of dilution potential. Quick note, this is not financial advice, just my take on public filings for educational purposes. This prospectus supplement is all about them selling more shares, and we need to understand what that means for existing investors. So what we have here is a filing that tells us the NXG Cushing Midstream Energy Fund, ticker symbol SRV, is planning to sell up to 1.5 million more of its common shares. This is what they call an at-the-market offering. Think of it like this: they're going to feed shares into the market over time, as the price allows, through a distributor. This is a closed-end investment company, meaning it has a set number of shares, but they can issue more. Their goal is to provide a high after-tax total return through capital appreciation and income. The fund is managed by Cushing Asset Management, LP, doing business as NXG Investment Management. Now the key part here is the at-the-market offering. The agreement with Foreside Fund Services, LLC, the distributor, allows them to sell these shares from time to time. The crucial detail is that they can only sell at a price that is at least the current net asset value, or NAV per share, plus any commission the distributor gets. They decide today whether to sell and how many. This flexibility, while good for the company to raise cash when conditions are favorable, can also mean a lot more shares hitting the market. They've also brought in UBS Securities, LLC as a sub-placement agent. The distributor gets a 1.00% commission on sales, and they pass up to 0.80% of that to the sub-placement agent. The investment advisor might even chip in to ensure the sales price isn't below NAV. It sounds complicated, but it means they are actively trying to sell shares and get them into the hands of new investors. These shares are listed on the New York Stock Exchange under the symbol SRV as of the 2nd of July 2026. The NAV was $47.02 per share, and the market price was $49.00, meaning the shares were trading at a premium to their NAV. This premium is likely why they're looking to sell more shares now. Of course, they're required to mention the risks. Investing in this fund has risks, including the potential loss of your entire investment. They use leverage, which adds its own set of risks. It is important for anyone considering this fund to read all the risk disclosures. The document itself is dated the 10th of July, 2026. Let's look at the strategy. The fund aims to invest at least 80% of its managed assets in midstream energy investments. This includes companies involved in gathering, transporting, processing, storing, and distributing energy products like natural gas, oil, and refined petroleum. They also invest in MLPs, or master limited partnerships, within the limits allowed for regulated investment companies. They are open to both equity and debt securities, and they can use derivatives to gain exposure. They're willing to invest in debt securities rated below investment grade, often called junk bonds. This means they're taking on more risk for potentially higher returns. They are directing you to other documents for more information, which is standard practice. The table of contents gives us a roadmap of the document. You can see they cover everything from the summary of the expenses to the risks, the plan of distribution, and all the details about the fund itself. Here they clarify that the prospectus supplement provides terms for the offering, while the accompanying prospectus has more general information. They explicitly state that if there is a conflict, the prospectus supplement wins. They include forward-looking statements, which are basically educated guesses about the future. They strongly caution that actual results could be very different from these predictions. This is standard legal language to protect themselves from lawsuits if things don't go as planned. They tell you where to find more information, like the SEC's website and their own website. This part is important. They're incorporating by reference information from other filings. This means those documents are legally considered part of this filing. It is a way to avoid repeating information. They list their statement of additional information, their annual report on Form NCSR, proxy statements, and current reports. This is a quick overview of the key points. It confirms the fund's name, investment advisor, and the listing details. NXG Cushing Midstream Energy Fund started operations back in 2007. It is a non-diversified, closed-end investment company. The investment advisor is Cushing Asset Management, LP, which is part of Swank Capital. As of March 2026, they managed about $1.9 billion. That gives you a sense of their overall scale. Again, it is listed on the NYSE as SRV. The fact that it was trading at a premium to NAV on the 2nd of July 2026, the 4.21% premium, is a strong signal that this offering is timed when the market is perhaps more receptive to buying shares. They intend to pay out most of their net investment income as monthly distributions. They also plan to distribute capital gains annually. However, they warn that distributions might include a return of capital. This is essentially giving investors back some of their original investment, which reduces their cost basis. They note that for the fiscal year ending November 2025, distributions were about 76% ordinary income and 24% long-term capital gains. This implies they are not heavily reliant on return of capital currently, but it is a risk to watch. This section reiterates the plan to sell up to 1.5 million common shares at the market. The minimum price is NAV plus commission. They emphasize that the fund and the distributor have full discretion on whether and when to sell shares. This is a critical point for existing shareholders. Their ownership might be diluted at any time the market conditions allow for sales above NAV. You'll see a whole section dedicated to risks, as required by law. They point you to even more detailed risk discussions in other filings. The money from selling these new shares will be invested according to their objective. They expect to invest most of it within 3 months. Pending investment, the proceeds will likely be in cash or short-term debt securities. This means for a short period, the money might not be earning as much as their main investment strategy. This table shows how the market price of the shares has compared to their NAV over different quarters. You can see during the quarter ending the 28th of February 2026, the shares traded at a discount to NAV with a low of a negative 3.66%. And by the quarter ending May 31, 2026, it was still at a discount, reaching a low of negative 6.84%. But then, as of the 2nd of July 2026, the NAV was 47.02 and the market price was 49.00, a premium of 4.21%. This shift from a discount to a premium is a key factor driving this new offering. They are selling into a market that is currently valuing the shares above their underlying assets. This section details recent distributions. For instance, on the 30th of June 2026, they paid a distribution of $0.50 per S-share. Before that, on May 29, 2026, it was $0.45. They also mentioned a special distribution of $2.14 in December 2025 to meet regulatory requirements. They again warn that distributions can fluctuate and may include a return of capital. As of the 2nd of July 2026, they had 6,234,375 common shares outstanding. After this offering, if they sell all 1.5 million shares, that number will increase significantly. This is pretty straightforward. They tell you to read up on the risks. Here they really lay out the details of how they're going to sell these shares. It is all about selling at the market with the distributor and sub-placement agent. They can sell the shares whenever the price is right, meaning for existing shareholders, there is a constant possibility of dilution. They remind us there is no guarantee any shares will actually be sold. This is an interesting point. The investment advisor can step in and pay commissions or supplement payments to make sure the sale price isn't below NAV. This is essentially a way to smooth the process of selling shares without pushing the price down too much relative to NAV. But it doesn't prevent the dilution effect of more shares being issued. This section deals with the lawyers involved. This is the main prospectus that this supplement builds upon. It covers the basics of the fund. The base prospectus mentions they can offer up to $500 million in securities, including common shares and subscription rights. This current offering of up to 1.5 million shares is just one piece of a larger shelf registration. Again, the high risk warning. This section provides more detail on their investment strategy, emphasizing their focus on midstream energy and their flexibility in investing in different types of debt, including below investment grade. They mention using derivatives, which can add complexity and risk. This table is crucial for understanding the costs associated with owning shares in this fund. There is a 1.00% sales load on the offering price, and about 0.07% in offering expenses borne by the fund itself. Management fees are 1.60%. Interest payments on borrowed funds add another 1.27%. And other expenses are 0.65%. So, the total annual expenses before any waivers are 3.52%. After a fee waiver, it comes down to 3.19%. For a fund that aims for high returns, these expenses are quite significant and eat into potential gains. The example shows that on a $1,000 investment, you'd pay about $46 in total expenses in the first year, assuming a 5% annual return. Over 10 years, that adds up to $386 in expenses for every $1,000 invested. This highlights how much those fees really matter over the long haul. This table shows the fund's financial structure. As of the 30th of November 2025, the fund had borrowings of $55.3 million. And if they sell all 1.5 million shares at $49 each, paying commissions and expenses, their borrowings would jump to over $91 million. The number of outstanding common shares would increase from about 4.6 million to over 7.7 million. This is a significant increase in share count, leading to dilution for existing shareholders. They state the net proceeds will be invested in line with their objective and policies. They estimate getting about $73 million after commissions and expenses, assuming they sell all 1.5 million shares at $49. Again, they emphasize that the actual proceeds could be less. This section reiterates that the shares trade on the NYSE and have historically traded both at a premium and a discount. This is a key piece of information. They are selling shares when the market sentiment is positive, leading to that 4.21% premium. More on risks. This is essentially a recap of how they plan to sell the shares, emphasizing the at-the-market strategy and the discretion of the fund and distributor. The 1.00% commission for the distributor is a direct expense of the offering. This outlines the various service providers like the transfer agent and administrator. Ernst & Young LLP is their auditor. This is about how they handle your personal information, which is standard. Alright, let's synthesize this. The NXG Cushing Midstream Energy Fund is executing an at-the-market offering to sell up to 1.5 million additional shares. They're doing this at a time when their shares are trading at a premium to net asset value, which is a good sign on the surface. However, for existing shareholders, this means potential dilution. If they sell all those shares, the total number of shares outstanding will increase significantly, meaning each existing share will represent a smaller piece of the company's total assets and earnings. The fund's strategy in midstream energy, including investments in below investment-grade debt, suggests a higher risk appetite, coupled with annual expenses around 3.19% after waivers. Investors are paying a pretty penny for management. The fact that they can continuously sell shares whenever the market price is above NAV, subject to their discretion, means existing shareholders are always at risk of their ownership percentage decreasing. This offering, while providing the fund with more capital, primarily benefits the fund by increasing its assets under management, potentially leading to higher management fees for the investment advisor. For existing shareholders, it's a dilution event that fundamentally changes their ownership stake. The biggest risk I see is the potential for ongoing dilution if market conditions remain favorable for them to sell shares, and how that impacts the per share value and distributions over time. What I'm really looking for is whether they can consistently generate returns that outpace these significant expenses and the impact of dilution for long-term investors. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.